This is the Daily Market Comment by Rafi Boyadjian and Maria Pashkudis. Thanks for joining us at XM.com. Equity markets remained in the red on Tuesday as global bond yields extended their ascent to multi-year highs, freaking out jittery investors already on edge about the dimming growth outlook following Russia's invasion of Ukraine. The 10-year Treasury yield in the United States scaled a more than 3-year high overnight. Increasingly hawkish rhetoric from central bankers, particularly from the Fed, has cemented expectations that monetary tightening will go into high gear in the next few months as inflationary pressures keep simmering, threatening to spark the biggest cost of living crisis in the Western world for generations. With optimism for some kind of a ceasefire agreement between Russia and Ukraine fading quickly, the S&P 500 has retraced more than 40% of the March rebound. But it's the tech-heavy Nasdaq that's bore the brunt of the renewed pessimism, as stocks with bloated valuations are less appealing when long-term borrowing costs are on the up. European markets and Wall Street futures were extending their losses today. In the currency markets, the US dollar reigned supreme once again, as rival yields have been unable to keep up with the surge in Treasury yields. The Japanese yen has been the biggest casualty of the bond market rout, as local yields have been capped at 0.25% by the Bank of Japan. However, the BOJ's prized yield curve control policy is under growing scrutiny amid the rapid depreciation of the yen and a record rise in Japanese wholesale prices. The yen plunged to a fresh almost 7-year trough on Monday and is on the verge of brushing new lows today. This has lifted the dollar index above the 100 level for the first time in 2 years, and there could be further gains in store for the U.S. currency from today's CPI report. U.S. inflation is expected to have spiked to 8.4% in March. In commodities, Brent crude futures were attempting to establish a steadier footing by reclaiming the $100 per barrel level following the gradual retreat from the March peaks. Having been hit by demand worries following the recent lockdowns in China, there was some good news today after authorities in Shanghai relaxed mobility restrictions for nearly half the city's population. Gold, meanwhile, was edging slightly lower, easing from yesterday's 4-week top when it came close to breaking above its month-long sideways range. This is today's Daily Market Comment. Thanks for joining us at XM.com.